Okay, so let's deal with tin capitalization. Tin capitalization is one of the anti-avoidance rule that the Commissioner General has set, or the law has set, on tax deductibility on interest. It is basically for tax deductibility on interest. So this is the background. So let me give you, we are looking at tin capitalization. Now, this is the background. The background to tin capitalization is a very simple analysis. Now, in section 9 of our tax law, so section 9 of Act 896, section 9 says that you are allowed as a business to deduct every expense. So section 9 talks about deductibility of an expense. So it says that you can only deduct an expense when it meets three conditions. All right. Basically, it makes it two. The first one is called residual deduction rule. That is section 9. So the one that you can deduct. So per section 9, I have given the acronym that I use is called new. The word new. So according to section 9, the residual deduction rule, it says number 1, before you can be allowed to deduct an expense from your profit, an allowable deduction from your profit, it must be necessary. It must be necessary that without that expense, you cannot produce an income. Number 2, it must be exclusive to the entity. So exclusivity is part of it, all right? It must be exclusive to the entity. So here it means that if your personal expenses are part, your personal side will be disallowed. So it must be exclusive to the entity and to the production of an income. All right, so that is that. And number 3, it says that it should be wholly. So all the expenses, not part. So if there is a part for you that was for personal purposes, we will segregate that. That one will be disallowed. Then the part that is for production of an income by an entity, that one will be allowed as a deduction that you can do. All right. So that is the section 9. Of course, the other thing about section 9 residual deduction rule is that the thing should not be a capital expenditure. The expenses should not be a capital expenditure. Why? Because for capital expenditure, you will be getting capital allowances on them. All right, you classify it and the pool system will give you capital allowance. So that is that. So unless you are doing it in the, what do we call it? Oil and gas. All right, so if it is petroleum, that one is different. So here, the thing is that people now are able to deduct some expenses on their P&L for tax purposes because they have met this principle. That is that. Now, from this background, we come to section 10. Section 10 deals with interest. So section 10 of Act 896 deals with interest. You and I know that when you go and borrow money, they will charge you an interest. So the question is that, are we allowed to deduct interest from our profit so that we can get profit before tax and tax? If you know FM, the Modigliani thing, telling people to borrow because interest is tax deductible, all right, you are allowed to, deduct the interest from your profit so that your profit will come down for it to be taxed. But if you use equity dividend people, the dividend that you pay to them is not allowed for a tax deduction. So that money cry in the first place is not even treated in your P&L. All right, but so interest, are we allowed to deduct interest? The question is, the answer actually is yes, unless, and that is the caveat. So section 10, talks about the fact that if only the money you borrowed, basis which the interest is paid, is used for the production of an income, because it is coming from section 9. So the money must be necessary for the production of an income. So it is saying that The interest that is allowed is an interest that is on money that you borrow. And the essence of that money was for you to what? Use it to produce an income in your entity. So that is the caveat. So it is allowed to the extent that the borrowed amount, all right, was used by the entity in the production of income. This is a direct way. Production of income. It's a direct way of saying it. Yes. So let's say I go and borrow money. And when I borrow the money, immediately I'm using the money to trade. Then it means that any interest that I pay on it should be tax deductible. It should be, you have to allow that interest to be deducted from my profit so that I can pay a less tax, because it was necessary for me to do the business. And I used the whole interest, whole of the interest, and it was purposefully for the business. So exclusivity talk about purpose. That is it. The wholly talks about quantum, the amount. All right. So this one is about the amount, the quantum. This one talks about purpose. All right. Necessity talks about need. That is it. Like you needed the money. All right. So that is what the law is trying to say. Now, if I go and borrow and I use the money to buy an asset and I use the asset to produce an income, do you think it's also supposed to be allowed as an allowable deduction? What do you think? I went to borrow money. When I borrowed the money, I used the money to go and buy a machine and I produce goods with the machine. Is this supposed to be allowed as an income? As an deductible expense? What do you think?
The amount borrowed.
You said you want an amount? No, I'm asking the question. Listen to the question very carefully. I said that I went to borrow an amount as a business and I use the money to buy an asset. And that asset, I use it to produce goods and sell. If I'm paying interest on that borrowed amount, the interest, is it allowed to be deducted from my profit for tax purposes? That's the question.
It should be allowed.
All right. Why?
Yeah, because it is necessary.
Exactly. So if you use the borrowed amount to also purchase an asset to produce the income, it is also part. Now, let me give you a last scenario. Let's say that I went to borrow money from someone, okay? I went to borrow money from someone and I used the money to actually start a business. All right, so I'm running with it. Now, I've been paying the money to the person, but it goes to a point where I don't have money again. So I'm going to do another borrowing to come and pay the liability that I had earlier. In this case, what do you think? If I'm paying interest on the borrowed amount to go and settle a liability, is that one too allowed? Because, and I've given you the situation that brought the liability. I actually first borrowed to go and purchase an asset. So what do you think? Then quickly we will go to that, what the law says, so that you can see section 10.
This one, it's likely that it might not be allowed because
why?
Yeah, because we can look at the wholly or the quantum aspect here.
Explain.
So you are borrowing the money purposely to to pay a liability.
Mm-hmm.
So in that sense, you see, usually from my perspective, I've seen that the interest is allowed because you are using the money to generate some revenue in which on the other side you will be paying tax.
Mm-hmm.
So if this very one, the government is not going to benefit directly, then it is likely that the interest will not be allowed.
I can't set it up.
Okay. Yes. Any other? Any other? Esther, what do you have to say about that? Mark? Esther, the feedback is coming from you, but I can't hear you. Okay, so let's look at what the law says. All right. Let me get you the position of the law on that, and so let me go to so that you can see. So what you said, yes, I have used the money to settle a liability. Now, the thing is that if I had not taken that liability earlier, will I have a business running? That is the argument. Will I have a business running? So it's section 10. So will I have a business running? This is the background for thing capitalization, and I'm coming to that shortly. All right. So just okay. So these are the deduction, and this is section 10 of Act 896. Now, like I said, the interest incurred by a person during the year of assessment under a debt obligation of that person is incurred in the production of an income to the extent that the debt obligation was incurred in borrowing money. The money is used in the year to acquire an asset that is used during during the year for the production of income, and the debt obligation was incurred in the production of an income in any other case. So the focus, like you are saying, the focus of the deductibility of interest is that you borrowed money and you use the money to produce an income. So like you said, DRA is on the position that when you borrow the money must be in a situation where to produce income for them to come and benefit again in the form of tax. So now the last illustration that I gave you is like it is an illustration of double borrowing. Watch this. So this guy went to borrow, and this borrowing one, he's going to pay interest. And this borrowing one, he used it to buy an asset to produce an income. So that is that. So it qualifies, borrowing one. Then the guy is clever, okay? He decided to go and borrow again. So he will be paying interest on borrowing two. The essence of borrowing two was to settle borrowing one. So if GRA, for example, allows for that interest, this particular interest, to be allowed as deductible, then it means that he can borrow another one and be borrowing and be borrowing and be borrowing. So the one that is actually allowed for tax deductibility is the one that was used to produce an income. This one is used to settle a liability, even though the liability was because he took another loan to settle an asset. At the end of the day, it is only on one asset. So the loan will be on the interest will only be allowed on the one that is directly to the production of an income. So that is that. So if you are using it to settle a liability, you are not producing an income. Therefore, the liability that is being used to settle the loan, settle the asset purchase is the one that will be the focus for tax deductible interest. So that is the background. So it means that what you need to take from this is that if I borrow money and now use the money that I have borrowed to finance an asset for which the asset is used to produce an income for me, which of course GRA will come and benefit again. It is allowed as tax deductible. Now, at the back of it is where people try to misuse the law. And that is why there is thin capitalization. Because what happens is that this is an entity. This entity can borrow from a bank, and Section 10 applies. But you see, the company doesn't want to borrow from an entity because you see the interest will be paid to a bank. And even though it is tax deductible, the company wants to be wise. He will therefore borrow from a related party, his own company, so that he can charge a big interest. So when the related party charges a big interest, do you know what is happening? He's just moving money from himself to this related party. And again, the interest per Section 10 analysis would have been deductible because he borrowed the money to finance an asset, which was used to produce an income. Please, do you understand? Is it understandable?
Yeah, yes.
So it's kind of trying to trick the law. Yeah. And so therefore, that comes in the concept of thin capitalization. And that is what thin capitalization has come to actually deal with. All right. That is what is happening. Okay, so like I was saying, it is at the back of this whole thing that the Commissioner General believes that this thing has to be dealt with, because other than that, people will be taking advantage of the law, trying to borrow money from themselves and also deducting the deductibility of the interest. So because of that, the Commissioner General decided to bring in, the law put in thin capitalization to help deal with that. Please, I hope you can still see my screen. Can see my board?
Yeah, it's clear.
All right. So because of that, the thin capitalization come to play. So this is what the law's position. Thin capitalization is Section 33 of Act 896 All right, and this is the provision in thin capitalization. All right. These are what you have to know. We're going to summarize it for you. Now, it says that if a resident entity, and so let's draw something like this. This is a resident entity. All right, which is not a financial institution. So let me position my resident entity here. Let me bring him here. All right, let me position him here. Now, this resident entity should not be a financial institution, because you remember we talked about a bank. All right, so that is that. If a resident entity other than a financial institution, i.e. the resident institution, should not be a financial institution, in which 50% or more ownership are held by exempt person. So this is exempt person. We will define an exempt person very soon. Now, the law says that who is an exempt person? The term exempt person means a non-resident person. All right. Or it also means a resident person. But that resident person, so it's a resident person for whom interest constitutes an exempt income, or is not included in their exempt accessible income. So it means that when we talk about a resident entity, we are talking about so far as you are established in Ghana, all right? So that is that. Now, we are talking about the fact that you have a permanent establishment in Ghana. Now, we are talking about the fact that even if you are a resident entity, then it means that any interest that you earn should be exempt. Should be exempt. So that is what the law says. All right. So it's either you have a resident, you are a non-resident entity, or a resident entity of whose interest is exempt. So that is the law, or it is not included as part of their accessible income. Now, if such exempt person, which of course can be a non-resident person, so we said that if a resident entity other than a financial institution in which 50% or more control, ownership or control is held by exempt person. So what we are saying is that this exempt person owns 50% or more. So that is what you need to take note of. If this scenario happens, please bear in mind that this resident entity should not be a financial institution. If it is, then capitalization is not applicable here. So we are talking about the fact that if this guy, all right, owns 50% into 50% or more in this entity, and this resident entity borrows money from this exempt person. So let's say he borrowed money, then it means that he needs to pay interest. If you have a situation like this, Section 10 will not apply to you. However, your interest that you can deduct is limited to a ratio of debt is to equity of 3:1. So the debt is the 3, your equity is the 1. So debt to equity ratio or not equity ratio, if you have more than 3:1 ratio, then it means that what is going to happen is that any interest that is over and above the 3:1 ratio will be disallowed. And any exchange loss, that is also above the 3:1 ratio will be disallowed. What it is trying to say is that the only interest that you can be allowed, like the case in Section 10, is the only interest that is within the ratio of 3:1. We are going to illustrate it with figures. Now, one thing you should understand is that the debt means obligation, present obligation, paid or unpaid. You understand this thing from IAS 37. Present obligation. Equity is the one that you need to be careful of. The equity is a combination of stated capital and income surplus. What is the other name for income surplus? The other name for income surplus is retained earnings. So please, the figure that you should have in your equity doesn't include capital surplus. Capital surplus is not part. I hope you know what capital surplus is. Something like your revaluation surplus, all right, all those things. So it won't be part. It is only stated capital, but retained earnings or income surplus. Please, are we clear? Are we clear? Hello, class. All right.
Yeah.
So that is that. So let's put it into practice. Let's put it into question. So this is a question that we have. So we will solve this illustration, and I think you get the understanding. Maybe we will pick one past question also, and we will drop it. All right, just to illustrate to businessmen and students how to work this one. So these are the conditions. This is your condition. You have to be very, very vigilant about it. This is your condition. So let's look at this question. We have Theodora PLC registered in Ghana. So this Theodora PLC is registered in Ghana. Now, the question says that he is an 80% subsidiary of Theophilus. So who do you think in this illustration that we have done here, where does Theodora belong and where does Theophilus belong? Who is the exempt person and who is the resident entity? So which one is which? Who is what?
Yeah, is that Theodora is registered in Ghana?
So Theodora will be the one resident. It made it so clear, so you can figure it out. All right. So that is that. So Theodora is registered in Ghana, and Theophilus is based in New York. So Theophilus is the non-resident entity, and therefore is the exempt person here. So, and the exempt person owns 80%. So it means that thing capitalization becomes what? Applicable. All right. So that is that. Now, it says that Theophilus gave loan amounting to 10 million US dollars to Theodora for a positive MPV project it had identified in Ghana. And at the time, the exchange rate was 5 cedis is to $1. So at the time, how much money did they borrow in terms of cedis? How much money is that? So they borrowed funds.
Million.
So 10 USD
Right.
will be how much in Ghana cedis? If 5 cedi is equal to 1 Ghana cedi, that would be like 50 million, right? Is that not it?
Yeah, it is.
That's 50 million. And it says that, and the equity and liability component stood at this. So their equity and liability, so debt to equity. So debt is, it says that their equity and liability components stood at 2 million, including capital surplus. So that will be for the equity, right? Which was a revaluation surplus and a debt of 8 million. All right. So equity is 2 million, but they are telling us that it includes a revaluation surplus. Now, we said that the stated capital, the equity here, should not include surplus. It should be made up of stated capital and only retained earnings. So in this case, the equity should be minus the 200,000. So meaning we will have 1.8 million. All right. So that is it. You need to be very careful. All right. That is that. And it says that at the end of the year, 2022, the exchange rate is 6 cedis is to $1. That's the end of the year exchange rate. Then we are coming to do the following information also exists here, as you can see. It is the anticipated interest to be paid. So per this information, interest is 98,750. Then foreign exchange loss is also 150,000. 150,000. So basically, that is that. Okay. So we are now going to find out how much we are going to be allowed as tax deductibility, all right, and how much we are also going to disallow as tax deductibility. Now, one thing you should bear in mind is that when you are preparing a financial statement, financial statements are prepared at the end of the year. Bear in mind, and that is where the GR people are interested in your, what do we call it, your tax deductibility and all those things. It is done at the end of the year. So bear in mind that, all right? Put that thing at the back of your mind because we will come to that. Now, what you have in here is that, fortunately for you, we have the interest figure. This is the interest. And this is the exchange loss. All right. Now, of course, you could have found the exchange loss yourself because this money that they did, which was at, what was the exchange rate at the beginning? 5:1. Then at the end, it's 6:1. So at the 6, you could realize that it will be 60, but we are not interested in that for now, but our own is to find out if the thing capitalization is applicable, because it is said that the ratio is supposed to be 3:1. So meaning that your debt should be 3 times your equity. So that is that. So if this is my debt, 8 million, what is 3 times my equity? All right, so let's write the figures in like this. What is 3 times my equity? Equity was 1.8 million. So times 3 will be what? Because that is what your debt should be. Yes, times 3 will be what?
5.4.
5.4. Okay, good. So you have 5.4 million. So it means that your debt that you have is more than the 5.4. So we can't allow you to deduct all this interest. It will be limited to the 5.4. And so how are you going to do that? But first of all, when a question asks you what is the possible tax implication, because you have already decided to quote this interest, the first thing that the GRA would do to you is to do withholding tax on interest. Withholding tax on interest, which is 8%. They will deduct that. Then they will recalculate the interest for you, because you cannot take away all this interest, because all this interest is based on 8 million. But think capitalization says it is limited to the ratio of 3:1. So it means that only 5.4 out of the 8 million of the interest will be allowed as interest that you can deduct. And how much is that? How much is that?
I'm having 6,656.25.
6,656.25. 56.25. All right. So this is the interest that you'll be allowed to deduct. It means the balance out of the 98,750 will be how much? That one will be disallowed. All right. So that is what you have here. So it means the balance is 32,093.75. This one will be disallowed because the ratio, it exceeded the ratio, and this one will be allowed for you to deduct from your profit for tax purposes. Not only that, the exchange laws too, remember that's what the law said. The exchange laws do the same thing. Foreign currency exchange laws. All right. The excess, those one that exceeds the ratio, will not be deductible. So that one too, we have to do 5.48 million out of the 150. All right. So what will you get for that one? I can't hear the other people's voice, but what will be it?
101,250.
101,250. So that will be the allowed one. The difference will be disallowed. So what is the difference?
That will be against the
difference out of the 150. How much would that be?
48750.
48750 will be disallowed. So it means that the tax implication is that you will pay withholding tax of 8% first on the 9/8 they had, and also you will be disallowed 32,093.75 and also 48,750. 0.00, then you also quote that the allowable ones are this and that. So that is thin capitalization. Don't forget, this is law, and you have to make sure all the parts comes to play, because for example, assuming that it's an exempt person, but it is in a financial institution, that one, you will not do thin capitalization. Assuming also that it is a resident person, but his interest is not exempt, thin capitalization will not apply. So these are the dynamics, all right? So, and this is what you have done. This is the one that is allowed. This is one that is disallowed. All right, so that is that. Okay, so basically that is that. Now you see these things in your exams throughout. You see it in your exams throughout. You see, these are typical examples of it. All right, these are typical examples of it. So the management of Kadidi Limited or Kadidi Limited, a company resident in Ghana since the year 2007 assessment year, is a wholly owned subsidiary from Danlerugu Limited, a company resident in Nigeria. So right there, you know that there is 100% ownership by a non-resident person in Ghana. And so therefore, you should start thinking of thin capitalization. And they invited the Kabadi has invited you, a final level 3 student of ICA, also an intern, tax intern with like Esther, who is a tax intern with the ENI people. All right, about for them to talk about the tax implication of a transaction. So they borrowed 10 million and to meet its operational needs. And the balance of their loan, as the balance on the loan account as at the beginning was 5 million and 4.1 at the end of. So we have this at the beginning, their loan account was 5 million, and at the end it was, what do you call it, 4.1. So this one, you see, you have a loan account at the beginning that is 5 million, and you have a loan account 4.1. So if you are going to do your ratio of 3:1, the question will now be on which one of these are you going to use to determine your liability? Which one will stand as your liability? So as we go on, I'll come back and ask you that question again, because we need to do the 3:1. And so is it the opening liability or it is the closing liability? It is something that you have to check, and I'll explain that one to you shortly. But let's finish reading the question. All right, so now when you come here, the rate at the end of the year, like the one we had 5:1 and 6:1 in our previous example. This one too, this is what it is. So we will come to that as we, so this is the rate at the beginning and this is the rate at the end. And the financial statement at the beginning, you see, at the beginning, it should prompt you on something. At the beginning, this is the stated capital, retained earnings, capital surplus, share deals are also in there. So we are now coming to now disseminate the entire, analyze it and disseminate it for you to be able to solve your thin capitalization about it. So now, these are the stated capital, retained earnings, and the interest that we are looking at is 9124. Are we going to allow all of them or disallow some part? And the exchange loss also is this. Are we going to allow all of them or we are going to disallow some part? All right, so these are the questions that we need to find out. So first of all, we know that the thing has met the thin capitalization criteria, but we need to do the debt to equity ratio. Debt to equity ratio. That is what we need to do. But first of all, what is your debt to equity ratio? Now, and the debt that is at the beginning, we have one at the beginning and we have one at the end. Which one are we supposed to use? You see, the thing capitalization happened immediately. And even the financial statement that you have is also at the beginning. So you can't compare end to beginning. So the debt structure that we use is the debt at the beginning. The debt at the beginning. And the equity too is also here at the beginning. So the debt we have here, therefore, will be 5 million. And the exchange will be the one that is at the start of the year. The one that is at the start of the year. So how do we convert this thing to equity? Ghana cedis. How will you convert our 5 million to Ghana cedis? It's 5 million. And they said that every $1 is equal to 5.2. So you can do the simplistic style. If 5.2 Ghana cedis is equal to $1, how much will $5 be? All right, so you don't know. So this one means that you need to multiply. So basically that is that. So X will therefore be equal to how much? When you multiply?
26 million.
26 million. So 26 million. Always do that because sometimes the thing can end you up in a division. So it means that in CD term, our debt is 26 million. So don't forget, we are using the opening figures because that is where everything stood. All right. Now, then the equity. You remember what the law says? The combination is which one and which one?
So I think we should. You've not said anything concerning the share deals when we
Share
started.
deal is also part of the capital surpluses. When we say capital surpluses, share deal is part. All those things are part. Treasuries, they are all part.
Okay.
Yes. So this one, if your equity accounting is low, you'll be affected. You'll be affected. No, in any case, the law said that it is a combination of stated capital and income surplus. So you don't need any statement for the others. Just look for those two. That's all. Don't bother yourself about the others. Now, it's just that another name for income surplus is what? Retained earnings. That's all. So it means our capital will only be the stated capital, which is 200,000, and the retained earnings, which is 1, 2, 3, 5. So it means in total is 1, 4, 3, 5. So this is what we are going to multiply by 3 and do that. Everybody do that and let's see. So let's see if it is comparable to this. If not, we will short. So first, in the first place, the interest of 90124 will suffer a withholding tax of 8% withholding. Then the allowing part and disallowing part. Let's find out. So when you multiply by 3, how much do you get?
1435.
1.
I'm coming, sir. That is 4305.
4305 million, right? Okay, so that is that. Now, it means that it is way of this. And so once after deducting your withholding tax of 8%, you can do that and find a figure. We now need to do 4305 out of 26 million and multiply by the interest to find out the part that we will allow. Then you will work the disallowed part. All right. So that is that. Find it out. Then the same thing will go for the exchange loss to 4,305,000, 26 million out of the 147 is what we will allow. All right, so get us the figures.
Yeah, so the interest. It's 7210. Well, it's 7209.92.
09.92.
0.92.
That is the allowable part. What about the disallowable part? The difference?
Not this, so the interest. The 8%.
Oh, the withholding tax. The withholding tax is what? 7209.92. Okay, so that is the withholding tax part. Okay. What about this part?
26,000 times 147,000. That is 24339. 339.81.
0.81. So this is the allowable part. So you can deduct it and find the disallowable part.
And that's 90124. 65
The disallowable part is what?
65784.19.
65
784
784 point what? 19. Okay, so that is the disallowable part. Okay, so you do the same thing for the interest.
So
work this one well, because I'm punching my calculator here to confirm the figures, but I'm having something different. I don't know if you can see.
This
For this one.
allowable parts.
Yeah, the allowable. I'm having 14,922.
Yes.
Have you seen it? Check it well.
The 24 will be for rather than disallowable.
The 24 will be for the disallowable.
The 147,000.
All right. So it means you have to be very, very careful in doing the computation, because I punched the same thing here. So I'm having 14,922.45. Then when I take it from the 9124, it's actually 75. The disallowable part is 75,201.55. So check it well. Point this side well. Yeah. So this is allowed. This is disallowed. Okay. Then let's do the same thing for this one. So 4305 divided by like 26,000 when you are removing the zeros, multiplied by 147. So that one to give me the allowable part, 24,339 points. I think that is what you gave me at first, right? Then minus the 147.
That's 147,000.
So the disallowed part for this one is like 122,660.19. All right, so that is that. All right, so but the question said that write a memo. So you write it in the form of a memo and explain to them. So these are the tax implications. This. All right, so you first have to explain the concept of thing capitalization from like this side. All right, explain from the law's position like this side. All right, when a resident person, a resident entity, which is not a financial entity, in whom an exempt person has 50 or more control or ownership, then it means that any interest in excess of the 3:1 ratio is disallowed. Foreign exchange loss in excess of the 3:1 is also disallowed. And therefore, you represent it with the figures. All right. So that is that. As for interest, this interest, every interest, a firm attracts a withholding tax of 8%. Individual is 1%. So you have to bring it in. All right. But this is a firm, so you apply 8%. So what I want you to do is to find all the think capitalization questions in the past question and deal with it. So there is some here. Deal with all the think capitalization questions. All right, in the past questions. That one will make you have confidence that you can deal with anything think capitalization. So they are in plenty. All right. So thank you very much. And this is where we will end it, and we will continue our class on Tuesday. All right.
Tuesday, that is just tomorrow now.
Yes, that is just tomorrow. Thank you.